Hi and welcome to Swisscope's Daily Market Talk. It's Wednesday, March 5th. Trump's tariffs went live yesterday, sending global markets, including the US markets, tumbling until rumors of a potential rollback started circulating. So high volatility is now driving investors towards safe havens like bonds and gold, while Trump-fueled rally in the US dollar index has now reversed. So the global financial markets were hit by a heavy sell-off yesterday after Donald Trump's tariff threats turned into reality for Canada, Mexico, and China. And the latter said that they would retaliate with similar measures as well. Just Mexico said that they would at least wait until Sunday to negotiate, but the US will be equally slapped back. So tariffs didn't really concern the Europeans so far, even though we know that there will be tariffs on European companies. But stocks in Europe took a very heavy hit yesterday as well, on the guessing that the next round of tariffs will certainly hit the old continent and companies here. So the European car makers, for example, are probably on the front line in this trade war, as the share of vehicles that are made in America is pretty low, less than 57%, for example, for the most American-made Stellantis. Then, the Made in America percentage stands at around 48% for BMW, 43% for Mercedes, and 21% for Volkswagen, and just around 13% for Volvo. The Japanese and South Korean brands and US made ratio changes between 64 to 19% as well. So these companies have had a pretty bad session yesterday on news that the tariffs will probably hit them and hit them hard. The overall market was down. The DAX got hit by a hefty 3.5% sell-off. The French CAC 40 fell 1.85%, while the Stoxx 600 index tumbled more than 2% at yesterday's trading session on tariff fear. The Japanese Nikkei eased to the lowest level since September, and the major US indices, from big cap, technology heavy, to medium and small cap benchmarks, they all fell below the levels that they were trading at when Donald Trump was elected the president of the United States last November. Now, it's quite curious though, because investors knew that these tariffs would go live yesterday, right? So there was no surprise there. So my guess is that the market's aggressive reaction suggests that a clear majority of investors were probably expecting Donald Trump to make a last-minute U-turn. But I think that he finally did. So there are now rumors out there since yesterday, just yesterday, that he would, well, eventually roll back some of these tariffs. So the DAX futures are up by almost 2% at the time I'm talking here this morning. The US equity futures are up as well, as Donald Trump yesterday called for a 52 billion US dollar worth of CHIPS Act subsidy, which could give a short energy boost to the chip makers in the US. But overall, really, I mean, the news flow becomes very, very much annoying, of course, as crucial decisions will change in a matter of minutes, really, not even days. Minutes, and the market's reaction is often aggressive. Obviously, the volatility is rising, and in an environment of rising volatility and uncertainty, many investors are naturally willing to stay on the sidelines and go toward the safer pockets of the market. As such, bonds, for example, are performing better than equities since Donald Trump is elected the president of the United States. And Bloomberg's US Treasury Index just returned more than 2% since Trump's election day, compared to just 1.6% return from the S&P 500 companies. And the earnings season was pretty strong, mind you. And with almost all companies in the S&P 500 having reported earnings, while 75% of these companies managed to beat their earnings expectations. That's not too bad, and the S&P 500 earnings grew by around 18% in the fourth quarter of last year, which is the highest earnings growth rate since the fourth quarter of 2021. Alas, companies issued more negative guidance than positive guidance for the first quarter of this year, and Target and Best Buy just joined in yesterday, warning that the US consumers we'll have to face higher prices because of Trump's tariffs, obviously. Why? Because let's get this clear for everyone. In opposition to what many voters probably thought, it's not the foreign countries' governments who pay the import tariffs of the U.S. government, and that just comes into the U.S. government's pockets. It's the companies, and the companies reflect the higher costs on their consumers. And it's exactly the same reasoning than inflation, really. Either the companies take on the additional costs of tariffs or inflation or whatever, and their profits come under pressure, or they try to pass these costs on to their customers to protect their profits, and their sales could get ahead by a variable margin, though, depending on the demand elasticity. And as with inflation, companies that manage to pass the price increases on to their consumers lose less money in this process than those that are not able to pass these additional costs on to their customers. But the problem is, because we are just coming out of a relatively high inflation period posterior to the COVID pandemic, the headroom to pass the price increases onto the customers is less for everybody, generally speaking. So yes, tariffs are toxic for the American companies as much as they are toxic for the other nations' companies. This means that America will probably not be great by destroying value around the world. Now, back to my discussion earlier of safe haven assets. I was saying that yes, the bonds actually outperformed equities since Donald Trump's election day, as despite a satisfactory earnings season for the S&P 500 companies, for example, while the tariff situation now puts a lot of negative pressure on earnings expectations, and that is obviously destroying value across the markets. And many investors are also actually moving toward the security of gold, as you know, as gold has been, as I said earlier, an ultimate hedge for the geopolitical and trade tensions. And in this sense, Glenn Coxon of NFG Partners, with whom I discuss once a quarter, he is taking a moderating approach for equities right now, increase allocations to inflation-protected bonds, and maintains his 10% gold exposure across multi-asset portfolios. He, however, is quite more optimistic than many are regarding the U.S. growth story in the longer run, and he actually argues that these mass deportations and the tariffs will be balanced, will have to be balanced by more market-friendly measures, including dramatic deregulation for businesses, reduced government waste, and potential for tax cuts, and also Doge dividend. I'll be getting his views in detail for next quarter later this month, and I can't wait. So stay tuned. We're going to see what he's going to say about it. But not everybody is very pessimistic. In the short run, though, the pessimism rules. Now, in the FX markets, the US jitters hammered the US dollar. This time around, the greenback couldn't come out of the tariff jitters victoriously. The dollar index slumped nearly 1% at yesterday's trading session and slipped below the major 38.2 Fibonacci retracement level on the Donald Trump rally, meaning that the Trump bump in the US dollar is now reversed. As such, the euro dollar rocketed past the 106 mark at yesterday's trading session and stepped itself into the medium-term bullish consolidation zone after clearing its own major 38.2% Fibonacci resistance level on Donald Trump-led sell-off. Cable, which had actually stepped into the medium-term bullish consolidation zone just earlier, is now testing the 200-day moving average resistance to the upside. The rebound in commodity currencies like Loonie and Aussie remain more contained, however, as the global trade tensions weigh on global growth expectations, which then weigh on the demand outlook for commodities. Now, inside oil, the fact that Saudi's Aramco has cut dividend recently, that was announced just yesterday, combined with OPEC's latest decision to restore output starting from next month, means that Saudis now have interest to maximize oil sales to replenish their coffers. As such, think that crude outlook remains comfortably negative in the short to medium run on the expectation that we will see an ample supply coming into the market as soon as April. Now, on the data front, investors will watch the US ADP report today and also the PMI and ISM numbers from both sides of the Atlantic Ocean. Now, the interpretation is going to be interesting because while the European investors could eventually brush off bad news off their shoulders on expectation that the US tensions will eventually boost activity in Europe sooner rather than later, also with the European Central Bank support, weakness in the US data will probably be perceived as bad news and should further weaken appetite for US equities, given that the Fed is going to have harder time to support the economies with inflation expectations exploding right now. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.